There are 4 sections of this chapter, of which I think we'll get through by Thursday. In addition to the lecture, we'll be pausing to do exercises. And because this is such a heavy journalizing-based chapter, I'll always give you the little bio, and then you'll fill in as I fill in. And then we'll do some exercises as we go as well. Okay, so I think it's going to be a really doable chapter as long as we're 100% focused. The entire chapter focuses on probably one of the most, other than cash, one of the most largest assets, and it's the whole notion of accounts receivable. What are accounts receivable? When people owe us money. Who are those people? Typically customers, yep, that are buying from us. Okay. I want you to find an area to just take these notes. There's not like a screenshot of it. Actually, maybe page 3 might be a good spot for that. At the bottom, like just like draw a line across the half of the page and just make notes at the bottom. I think it's important to get some of the vocabulary in. Receivables are amounts due from individuals or other companies that are expected to be collected in cash. Typically customers. Let's say that again. Amounts due from individuals or other companies that are expected to be collected in cash. We're going to learn about 3 types in this chapter. The 3 include traditional accounts receivables, as we know it. Amounts owed by customers, basically buying from us, but they charge it. And you'd argue, we know this already. We've been studying this for 9 chapters now. You'll find out the big curveball with this chapter in a minute. Tell me the answer to the middle one. When the ARs don't pay their bill, time and time again, what do we usually turn them into? Notes receivable, we turn into a loan. A formal instrument of credit, that's what a loan is, are issued as proof of the debt. So basically they can't pay their bill, or maybe they're borrowing a substantial amount of money from us, and we're going to say, all right, we're going to turn you into not a accounts receivable, but rather a notes receivable. You're a loan now. We're loaning you the money. What else are we going to charge with this? What else are we going to earn? Interest revenue. That'll be a plus. We're going to earn interest. If we're working with our bank as the middleman, what will we see as a subtraction from this? The fee or the service charge that a bank would, if we're working with the bank. So you know accounts receivables. They're an asset. Notes receivables are also an asset. A third type of asset are what are called other receivables. They list 3 examples. I'd say this is the most common. Like when we borrow money to an employee, seems kind of weird. Income tax refunds are another one, or interest loans to officers, with the middle one being probably the most popular. So if we borrow money to an employee, that's considered an other receivable. In all 3 of these camps, it goes back to this. Amounts due from these people, and we hope we get our cash back. There's a lot of heavy vocabulary there. What can I still answer? What are you still wondering? We'll move on. You'll find out in the past, the question was asked, does a AR turn into a note receivable if they can't pay their bill? In the past chapters, yes. You'll find out in this chapter, what do we do when people don't pay their bill? There's a whole accounting process that goes with it. So what you need to know the difference between an AR and an NR, AR, they're going to probably pay their bill. Notes receivables are, another word for that is a loan. We're giving a customer a loan, okay? You don't have to put this in your notes, but I just want you to analyze some real companies. Amounts due from individuals or companies that are expected to be collected in the cash. You see that receivable vocabulary term there again. It is, just want to look at my notes the right way. I don't have them. It is the next largest asset to cash. Cash is typically the largest asset a business has, and this is a very close second. Now, we're not, in terms of liquidity, you hope that an AR will get you your cash back, okay? So it's liquidity is hopeful. We want to turn it into cash as fast as we can. Look at this. These are some big percentages. Receivables as a percentage of the total assets. So out for General Electric, 52% of their assets are floating out there. ARs that owe money. Do you think that's a pretty startling statistic? It means that 52% of the assets that GE owns are not in-house. They're floating out there. Customers owe them their money. Ford Motor Company, 42% of their assets are owed. They own the right to getting them, but they're not there. So I think these are pretty big percentages. Where you look at 3M, a Minnesota-based company, 14% of them, 14% of their assets are tied up in AR. What does that big dramatic drop tell you? Does 3M let their customers charge very often? Look at Intel, a computer company. Only 5% allow their customers to charge. So a pretty big span. Right here, these guys have a lot of assets tied up in other people's hands. They own the right to getting paid, but are they going to get paid? And that's the big question that I'm going to propose to you in 9.2. Let's talk, so we're already moving on to the second section of the chapter. Getting right into the packet that I gave you. These AR journal entries are really a review. What we're going to do on this page, it's really a review. But let's just pretend we're really brand new at this. Assume that the Jordache Company on July 1 sells merchandise on account to Polo. So this is us, and this is a customer. $1,000 worth of stuff. The words terms tell me that it's on account. We now know what these terms mean from a previous chapter, don't we? We hope that they pay within 10 days, because what are we going to do? We're going to give them a 2% discount because it's worth 10% off to us that we can recover that asset, okay? Prepare the journal entry to record the transaction for the books of Jordache, okay? In the past, the book has preached 2 transactions here because we have, you know, the on account, but then we have the inventory, not for this chapter. There's a big, so yeah, there's been 2 transactions, but I want you to say not for this chapter. This chapter wants you to really learn the AR side of things, and they want to just put the inventory that's leaving and the cost of goods sold on a back burner. Don't worry about that. Okay, so what would this transaction look like? What is going up? AR is increasing. AR, comma, Polo Company, if we really want to be specific. That asset is increasing, hence the debit. What do we own? What part of this asset do we own? The right to getting paid. What is our credit? We sold something, so sales revenue is our credit. Remember, we are not worried about inventory gone and cost of goods sold going up. We're not worried about that part of the transaction. That is its simple nature right here. Are we worried about the 210 and 30 yet? When do we worry about that? When they pay. If they pay within 10 days of July 1, then we're going to throw them a deal. What happened on July 5th, though? How much? 100. Are we going to worry about inventory coming back and cost of goods sold going down? No, we're not worrying about that part of it. Okay, so what's our debit? Sales returns and allowances. Remember, the second part of that would have been inventory, but we're not worried about that. What's our credit? Who owes us less? Polo gave $100 back. So if I were doing this in a T account format, this AR would originally, what would they originally buy? $1,000? Why are we knocking $100 off what they owe us? Because they brought it back. Pretty simple. And then on July 11th, we received their payment. Whoa! According to this, they owe us $900. Why'd they only pay $882? We gave them the 2% discount. I hate when this happens. Oh, we have 2 debits that are going to equal what? The $900 credit that they originally owed us. But they paid within the 10-day time period. Did they pay just on the right day? Yeah, if they would have waited till the 12th, it would have been a 900-900 split because they owed us 900, they paid us 900. But we cut them a deal with a debit of a sales discount. Remember, a sales discount is a sales contra account. Because remember, sales has a debit balance or credit balance, but if we're going to offset that, it's considered a contra account that acts opposite of its partner. I didn't show you anything new there. It's just getting your mind trained. Oh yeah, this is how ARs work. Now, what's going on in the last transaction? I want you to circle the word retailer, and I want you to add the word credit card there. There's a whole section of the chapter that talks about the retail credit card industry. Whoa. Do not get sucked into that. Every retailer out there has a store credit card. They're going to promo, give you every incentive to sign up for it. We're going to give you this free t-shirt. Like there's a whole booth at Scheels that in the middle section there, where if you go sign up for a store credit card, they're going to give you a Scheels t-shirt. What else are they going to give you with your monthly bill? Do they really give you gift cards? Oh man, they really dangle a carrot. But you know what else is assessed with a store credit card? Super high interest rates. Super high interest rates. I've seen store credit cards that have 30% interest rates. Like if you go have a $100 purchase, if you don't pay that bill off right away, you're going to be assessed $30 or 30% of that credit card statement. Yikes. They're going to dangle the t-shirts and the gift cards and the points and the mileage at you as much as they can. And who gets suckered into this more than anyone in society? College kids. They've actually saturated the college kid market, and they're moving it to the high school level. It's scary. Okay, and they're going to tempt you with every single thing. And I would be a hypocrite to say I don't have one. I used to have many, and all I ended up doing was cutting them up with a lot of tears and pleading with my bank to help me get out of debt, help me get out of this debt. We still have a Cabela's card just because my husband likes the points, but still, is it worth that high interest rate for the free t-shirt and a few points? Not really. And so you have to take into account how this all works. Assuming you owe $300 at the end of a month and your retailer charges 1.5 on any remaining balance. So here's my balance. It was really fun to swipe and add up to 300, but do I owe 300 anymore? No, I owe more. I'm going to owe $4.50 more. And they're making revenue off me. The AR goes up, that's me, and now they are making $4.50 interest revenue on just having that plastic swipe. And then you know what they do? They partner with the big credit card companies, so you can swipe other places. Like I can use my Cabela's, I forget if it's Visa or MasterCard, anywhere I want. Because then the tendency is I'm going to swipe more places. And then they're going to earn even more interest revenue on me. Some are exclusive. Some are very much exclusive. They tempt you with everything. Herberger's. They have really nice like Godiva chocolate by all of the tills. And there's a sign right there. If the cashier does not offer you an in-store credit card, we'll give you a free Godiva chocolate. And I'm always like, today's the day. They're going to forget to ask, and they never forget to ask. She didn't. Oh boy. Oh boy. Wow. So you might say $4.50. That's not going to add up. Is everyone's end of month balance only $300? It's usually in the thousands. And then that of course gets even more. How did we get at $4.50? We of course took 300, which was the remaining balance, times 1.5%. Well, right, but so like this. Yes, yep. So then we move, of course. So okay, here's the big kicker. What major retailer only has a 1.5% interest rate? Not very many of them. Honestly, it's 25 to plus percentage. If you take 25% times 300, we're looking at a much larger interest revenue that credit card company is earning off us. So now here's the big question. Big question of this whole chapter. Do all ARs pay their bill? You guys are telling me no. So why? They don't have enough money. Briar's right. They forget. They don't care. You mean to tell me people and customers really go charge, and they know they're not going to pay their bill? What's going to happen to them? We're going to charge them more money, but they're not going to pay their bill anyway. So why does it matter to scare them a little bit? What else is going to happen to them? They're going to what? We're going to take something of theirs, collateral. Usually collateral is not set up with a AR, but it typically is set up with a notes receivable. If you don't pay this bill, we're going to take your house or take your car or take your boat or take your four-wheeler. That's what collateral is. Your credit goes bad. Mitchell? Like when we loan money to our employees. But that's an internal thing, like if we're giving money to our yes, good. Okay, so let's answer this question. Go to the next page in your notes. Yep. When people don't pay their bill, they're deemed uncollectible. And you guys are telling me this happens. You don't have to open your books, but I want to read to you a portion of the feature story at the beginning of chapter 9. I'm not going to read the whole thing either. Sometimes you have to know when to be very tough, and sometimes you can give them a bit of a break. There's a fine line between you want a good relationship with your customers, you let them charge, you trust them, you build that trust, but you also need to bring in the money. Like you can loan all you want. GE's loaning 52% of their money out and let their customers pay their bill. Ford was 48 or something. 48% of their assets are tied up with ARs. So you want to foster those relationships with your customers and let them charge and build that trust, but you also have to get those ARs liquid. You need to get cash in your pockets. Once the accounts are established, so it's this lady that they're interviewing during this feature story, I get an aging report every single day. The rule of thumb is that we should have at least 85% of our receivables current, meaning they were billed less than 30 days ago. But we try to do even better. We like to see 90. At 15 days overdue, so a bill was sent 30 days ago. At 45 days, do you think they're just going to say, we're done with you? We're taking your house. We're sending you to the credit reports. What do you think they do first? If a customer hasn't paid their bill, it's 15 days overdue. Actually, they probably, they're going to call them. And that's what this feature story company is doing. Okay, it looks like it's a pharmaceutical company. They're going to call them. So you mean someone's job is to get on the phone and track these people down? Yeah. Then they send a written letter. Then they send a final notice. And at that point, they turn it over to a collections agency. So is this all happening in the first 15 days past due? Do you see how this can drag on for months? So then what happens when we write them off? We're done with you. And then they come, I'm sorry, here's my money. Are we going to say, no, we don't want your moldy money? You didn't pay us the first time. We're going to probably have to reopen the account and things get messy. Okay, and we're not talking some like little mom and pop floral shop here. We're talking multi-billion-dollar companies that have 52% of their assets tied up in people that owe them money. Do you think the AR recovery department is a pretty big deal at those companies? Yeah, it is. And so there's really two approaches you can take with these naughty customers. They don't pay their bills. It goes past due. We call them, we write to them, we call them again, and then we send the collection agencies after them. They're deemed uncollectible. We're going to run a ratio in the last portion of the chapter to figure out, you know, on average, what percentage of these ARs are we not getting back? And it's just a kick in the shorts to us, but we have to plan for that. Okay, so here's what you need to write down. There are two methods. And I'm going to give you a visual. Do you guys see the balloons on that page too? I'm going to give you a visual here in a minute. I almost thought about getting helium balloons today for school, but enough with the props. Okay, there's a direct write-off method and there's the allowance method. You're seeing that the direct write-off method is, in theory, undesirable because it's all or nothing. We either write you off and you're done, or we hang with you. It ends up being too dramatic, and you need to know that GAAP doesn't like direct write-off. They're going to tell you, hang with us here. Let's call them, let's allow for this instead of this big chop off, you're done. Who does my balloon example is going to make it more visually appealing, okay? No matching means, like, and you're going to see it in an example here in a minute, the balance sheet's going to show all these assets, and all of a sudden the income statement's going to show nothing because we didn't get our sales. And so it's too dramatic. Whereas the allowance method, you just allow for ARs that aren't going to pay. You know that they're not going to pay, so let's allow for it instead. It ends up being better. GAAP likes allowance better than write-off. Get these terms down, and the balloon example that the chapter gave us is going to make much better sense. Yes. Matching means like that money in is matching money out. Which one does GAAP like? Okay. Which one's more dramatic? Okay. And the book actually gave this little balloon example. I'm going to go to the next slide. I want you to write GAAP doesn't like this one, and you're going to see why GAAP likes this allowance better. Okay. Let's just take a look from 2014 to 2015. I think the questions are, can you explain this a little bit more? This visual helps. Okay, in 2014, let's assume this is a college kid. They've been promoting, buy on credit, woo! And sales look like they've gone through the roof. Yeah, they might be on account. And here's what the matching starts to mean. Sales looks like they went up dramatically, but everyone charged. And so AR also looks like it goes up dramatically, okay? If an AR goes up dramatically, what does that mean? Assets. The balance sheet's going to look really healthy. And so here's the balance sheet. Here's the income statement. Sales went through the roof. Assets went through the roof. Whew, times are good. But then all of a sudden, all of these ARs into your 2015 don't pay their bill. So did we really have the sales? Yeah, we had the sales, but now we don't have any money to back it up. And wham, wham, wham. It's like shooting darts at these balloons. They deflate because we threw a dart at them. They're gone. We write them off. Customers default on their loans. They're not paying their bills. Bad debt expense increases dramatically, and the AR plummets. Like they get wiped out. We don't even get them back. So we made all these sales. All these college kids walked away with all of our stuff, saying, "Yep, we'll pay our bill. Yep, we'll pay our bill." The next year, we threw darts at those balloons. Think of these balloons like little ARs. Here's a little AR. Here's a little AR. Here's a little AR. All these college kids are running around owing us money. And then chop, 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 they're gone. We write them off. It is, you'd say, come on retailers, why are you targeting these college kids? Okay, so here's the same bunch of college kids. So here's an AR, here's an AR. I want you to write ARs by all these balloons. If you go with the allowance method, instead of throwing a dart at one of the balloons and saying, we're done with you, yeah, we're going to allow you to charge on account. Go ahead and take our stuff, and here's your AR balloon that you have to walk around with looming over your head. Instead of throwing darts and saying, we're done, you're not paying your bill, we're done, we're writing you off. You know how when a helium balloon kind of, it's been sitting around for a while and it deflates and it kind of just lingers around on the ground? Instead of throwing a dart and going like this, we're going to just allow that this might happen. In fact, instead of it might happen, we know it is going to happen. And so instead of throwing darts and saying we're done with you, let's foster this working relationship that we have. Let's trust each other. Yeah, we're going to lose a couple of you. You're going to kind of go stagnant and start rolling around on the ground instead of being this tip-top helium balloon. We're going to allow for that to happen, but instead of chop, 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 we're going to really work hard at the ones that aren't paying their bill to get them to pay, and we're just going to allow for some of this to happen. Do you see why Gap likes this better? Because these ARs are recoverable. These ARs, we're going to get our money. Versus these 3 ARs, we just said, you're not paying? Okay, we're writing you off. We're done with you. Whereas down here, we're going to work really hard at allowing this to happen. We know we're going to take a kick in the shorts, but we're going to work hard at getting these ARs to pay. And instead of this, yeah, we're still going to see a sales increase. But in the next year, we're not going to see this. Rather, the ARs are going to be more like a plateau. We're going to get our money out of them with maybe a dip from one of them. This is not matching because matching, this is skyrocketing, and the next year it's plummeting. Whereas this, yeah, we see a big increase, but instead of dip, it's plateauing. Okay, now, we're going to do this right away tomorrow. I'm a couple sheets short, but that's okay. We can do this together if we all just focus.